This investigation is based on publicly available reports, court documents, regulatory findings, and reputable journalism. Imagine working for a bank that had survived for more than 2 centuries. A bank that financed empires, helped governments, served the British royal family. A financial institution so respected that people believed it would exist forever. Now imagine that history ending. Not because of a war, not because of a recession, not because of a global financial crisis, but because of one trader, one office, one hidden account, and a series of decisions that nobody stopped in time. This is the story of Barings Bank, a bank that survived 233 years, but couldn't survive one employee. To understand why Barings collapsed, you first have to understand what Barings represented. Founded in 1762, Barings wasn't simply another bank. It was part of British financial history. It financed governments, supported international trade, helped fund major infrastructure projects. For generations, its name became synonymous with stability. In London, Barings wasn't just respected, it was trusted. That trust became so deeply rooted that very few people imagined the institution could fail. After all, how could a bank that had survived revolutions, wars, depressions, and economic crises be threatened by one individual? That question would only be answered centuries later. Nick Leeson didn't arrive as a superstar trader. He wasn't famous. He wasn't considered a financial genius. He was ambitious, reliable, and willing to work hard. Barings eventually sent him to Singapore to help expand its derivatives trading business. On paper, it looked like a promotion. In reality, it became one of the largest failures of internal controls in banking history. Leeson was given an unusual responsibility. He supervised trading operations, and he also supervised the department responsible for checking those same trades. Think about that for a moment. The same person making decisions was also responsible for verifying whether those decisions were correct. It was like allowing a student to grade his own exam. The system didn't fail because Leeson was dishonest. The system failed because it assumed honesty would never be tested. Every great financial scandal has a place where reality begins to split from the official story. For Barings, that place was account 88888. Originally, it was supposed to be nothing more than an error account, a temporary place where small trading mistakes could be recorded before being corrected. Every bank has procedures for handling operational errors. Nothing unusual. But over time, that account became something completely different. Instead of correcting mistakes, it started hiding them. Every losing trade that should have been reported honestly could simply disappear into account 88888, at least on paper. The remarkable part wasn't that the account existed. It was that nobody seemed interested in asking why it kept growing. Losses became larger. Positions became riskier. Yet, every official report reaching London continued telling a story of extraordinary success. Barings believed Nick Leeson was one of its most profitable traders. In reality, he wasn't generating profits. He was hiding losses. The illusion survived because every new winning trade wasn't used to build wealth. It was used to buy time. And in financial history, time is often the most expensive asset anyone can purchase. At first, the losses were manageable. A bad trade here, a failed prediction there, nothing that couldn't be recovered. Or at least, that's what Leeson believed. Like many traders before him, he convinced himself that one successful trade would erase every previous mistake. When a market moved against him, he didn't reduce his exposure. He increased it. The logic felt strangely reasonable. If one position loses money, a larger position can recover everything. Until it doesn't. Every attempt to recover losses required even bigger bets. Every bigger bet increased the potential damage. Barings wasn't watching an experienced trader managing risk. It was unknowingly financing someone trying to escape yesterday's mistake. This pattern has appeared throughout financial history. Casinos call it chasing losses. Investors call it averaging down. Banks call it unauthorized trading. Different names. The same psychology. Because once your objective changes from making money to recovering money, risk stops being a calculation. It becomes desperation. On January 17, 1995, nature delivered a shock that financial models could never predict. A massive earthquake struck Kobe, Japan. More than 6,000 people lost their lives. Entire neighborhoods were destroyed. Markets reacted immediately. The Nikkei index fell sharply. For most investors, it was another tragic market event. For Nick Leeson, it became a catastrophe. His positions depended on the market moving in the opposite direction. Instead, every point the Nikkei fell pushed Barings deeper into losses. And because those positions had become enormous, small market movements produced extraordinary financial damage. This is one of the cruel realities of leverage. It doesn't require a historic market crash. Sometimes, a perfectly ordinary market movement becomes fatal because the position behind it has grown far beyond what anyone intended. By this point, Leeson wasn't trying to make money anymore. He was trying to survive another day. Reality finally arrived in February 1995. The hidden losses had reached approximately £827 million, an amount larger than the bank's available capital. Barings wasn't merely losing money. It had already lost more money than it could possibly survive. Nick Leeson fled Singapore, leaving behind a short message. "I'm sorry." Those two words became one of the most famous notes in financial history. Within days, a bank that had existed for 233 years was insolvent. Eventually, Barings was sold for the symbolic price of £1. Think about that. More than 2 centuries of history, reduced to £1. Not because of war, not because of recession, because a system trusted one person more than it trusted verification. It's tempting to believe Barings collapsed because of Nick Leeson, but that's only part of the story. Nick Leeson created the trades. The system allowed them to remain invisible. Financial disasters almost never begin with one catastrophic decision. They begin with hundreds of small decisions that nobody believes are important enough to question. One missing report, one ignored warning, one delayed audit, one manager assuming someone else has already checked the numbers. Over time, those tiny failures begin connecting to one another. Eventually, they become stronger than the institution itself. Barings teaches a lesson that every modern company should remember. Controls exist because trust eventually fails. Verification exists because confidence can be manipulated. History often celebrates visionary leaders, but institutions survive because of ordinary procedures repeated every single day. When those procedures disappear, history becomes surprisingly fragile. Barings Bank survived revolutions, empires, wars, and economic crises. What it couldn't survive was believing that success no longer needed verification. The collapse wasn't caused by one trader. It was caused by a system that stopped asking difficult questions. Because in finance, the most dangerous risk isn't the one that's hidden. It's the one everyone assumes someone else has already measured. History remembers the collapse. We investigate the pattern. Every financial crime leaves a trail. Follow it.